Usually the CCI will go up and down with the chart, but like with other indicators, there can be divergences. It happens to a lesser degree here for a brief period. Then, like normal, the CCI and the chart begin to have the same approximate movements again. When divergences occur, they can indicate a trend can begin to slow down or even reverse. Now, this is not strictly a divergence, but it may first appear the CCI and the chart are not closely approximating each other's movements. This is because the first major part of the trend that goes over the moving average will initially create more distance above the moving average, resulting in a higher CCI value, compared to this similar yet later portion of the trend, which is of course higher than the first portion, but by this time CCI values are slightly lower, as the naturally lagging indicator of the moving average begins to catch up and close the distance between the line of the moving average and the closes of these more recent candles. And since the CCI is based on how far these candles are closing from the moving average, the values will be slightly lower than before. Coming up here is a more noticeable divergence, where CCI remains relatively flat while the chart continues to close significantly higher. This is to be expected, as we've seen in previous examples. A strong uptrend will see the chart continue to rise on a steeper angle, usually as long as CCI values can sustain at or above 100. Since this divergence between the inclined movement on the chart and the relatively flat CCI hovering around 100 lasts for an extended time, a reversal becomes more likely, and movement of the chart and the CCI will generally return to being quite similar. Though it should be noted, an immediate reversal isn't always guaranteed, even if there is such a noticeable divergence like this. Sometimes the trend can flatten for an extended time before reversing, or just retrace slightly before continuing higher.